Hello, everyone, and welcome to your Glassnode on-chain update for week 24, 2022. So we have seen a pretty dramatic sell-off with prices coming down to almost touch the realized price. Now, this represents the on-chain cost basis of the entire market and has been a psychological and very significant level throughout Bitcoin's history. Now, when we look across a number of metrics, we are starting to enter what has otherwise been the deepest and darkest phase of previous bear markets. So we are getting into some pretty dark territory, and really what we're going to explore here is some of the dynamics and some of the historical oscillators that help describe where we are in the current market structure. So as we come down to the mid 20,000s, we've seen a plethora of macro indicators starting to get into this very, very deep phase of bear cycles. We're starting to see things playing out that look like what we see at the very end. Again, that doesn't mean that things are over, but it means we're getting into territory where, as of previous cycles, this is kind of the final capitulation, the flush out. It can take time to happen, somewhere between 8 and sometimes 24 months. This thing can take time to play out, but we are in that final phase where we're seeing that things have kind of reached the point where maximum pain is in play. So what we've seen is that prices have sold down and almost visited the realized price. This has historically been one of these long-term bear market floor models. We do tend to slice below it for a period of time. It doesn't mean it will happen this time, but it also doesn't mean that it won't. What we're looking at is where we sit relative to previous cycles, because really this is kind of the psychological basis that we have to assess how people behave during these different times. Now, we've also seen a handful of metrics that have actually deteriorated in terms of the fundamentals. We're seeing on-chain activity continue to languish and transaction volumes remain very, very quiet. So the fundamentals do unfortunately support further low prices. But what we're starting to see is this purging of even the strongest hands from the market. Long-term holders are actually spending coins with a higher cost basis than their short-term holder counterparts, which again is one of these metrics that starts to signal we're getting into late-stage bears. So as usual, please do give us a rate, review, and subscribe. It really does help this channel. Hopefully you're okay. I know some of these bear markets can be very, very challenging. This is my second or third, if you count 2019 bear market cycle. So having seen these things before, they do go through these periods where it's very, very volatile. Things are very challenging, but they do eventually start to hammer out bottoms. And again, with the macro backdrop, it's a very challenging environment. So what we're going to try and do today is just explore a lot of the metrics that give us a bit of a roadmap as to what this has looked like in the past and how we can really assess the depth of where this bear currently is and where it could go to. So as we can see from our price chart, we have essentially continued to break down. This is now we've now had 10 out of 11 red weekly candles. And really, if you count this one as a green candle, it was a fairly disappointing performance. So really, we've had 11 weeks of just straight downwards candles, which does put this into well and truly the worst drawdown, continuous drawdown in some time, I think, in history. We previously had some of 6 weeks down in previous cycles, but we're essentially going for the double on that at this point in time. Now, this metric is extremely powerful. This is one of probably the most fundamental metrics in all of on-chain analytics. There's a handful of these foundational tools that we use, and the realized price is really one of these. What the realized price is it captures the average price of every coin as valued at the time when it last moved. So the way to think about it is it's like the on-chain cost basis. It's the price that people paid for their coins. If you assume that you withdraw a coin from an exchange approximately around the time that you purchase it, then that generally reflects that acquisition cost. Now, as the market moves up and down, people will then spend those coins realizing a profit or a loss, and that then changes the shape and magnitude of this blue curve here, which is the realized price. So when we sum all of those coins together and take an average, what is the average price paid? Now, we can see back here in 2018, it formed that bear market floor. We kind of hovered above it through most of the 2018 bear until in November 2018, we collapsed down below it. And this really signified that the market on aggregate was now at an unrealized loss. And the orange curve we have back here is the MVRV Z-score. This is taking a statistical view of the ratio between price and the cost basis. And as you can see, when we break down below this white line, we're essentially in a period where the market on average is underwater. The average holder is now having an unrealized loss. Now you can also see that historically this has tended to form this kind of late stage bear cycle. We caught it here again in March 2020. This was a very brief 4-day window before we bounced back above it. And you can see here that we are essentially hovering barely a few $100s above it at the time of recording. And we're coming down to test this cost basis. And given that there's not much, we didn't spend much time in this price zone on the way up. It kind of rallied from 20,000 and next second we're up at 30,000. So very little transactional volume occurred through here. So that means that really this realized price is offering this fundamental psychological support that it has provided in the past, but also we have spent time sliced down below it. So we are getting to that point where it's really at the psychological cost basis of the market, and we will have to see how it plays on from here. Now, within this context, we are still seeing certain cohorts of the market continuing to accumulate. Now, again, just because accumulation is happening does not mean that prices can't go down. What we're seeing is a changing of ownership structure. Over time, various sellers will transition their coins to a new buyer. Sometimes that buyer will sell again, and eventually those coins find someone who's going to take it off the market. And really, the end of a bear market can only happen when sufficient accumulation by the right investors has taken place. And given the macro environment we're currently in, there's still a lot of that process going on. We're still seeing that distribution, and those coins haven't yet found that final home with a long-term hodler. Now, what we can see is we had this near perfect score for about a month. This was a very long period where we had a large amount of accumulation that was going on. In general, this is led by whales and shrimps, and we define these by whales being more than 10,000 BTC and shrimps being less than 1. Now, note that this excludes exchanges and miners, so we are looking at actual wallets that are more or less capturing investors at this point in time. Now, as we've seen this sell-off over the last couple of days, this has softened. This is actually fairly normal. We see this softening out of these types of metrics because we don't have that kind of floor getting put in. We tend to see these happen, these consolidation phases where we get that accumulation occurring. And if we look down here at our shrimps on the left and our whales on the right, we're looking at their 30-day net position change. How many coins have they been adding to their balance over the last month, which again is really capturing this recent consolidation phase. And we can see that shrimps have actually added a non-trivial amount. You can see it's actually much higher than we've seen at any time through the last 2 years. They're stacking upwards of 23,000, 21,000 BTC per month. So the shrimp class has actually added about 0.45% of the circulating supply to their balance since the November all-time high. Now, again, this doesn't necessarily mean that they're right or they're wrong. We're just kind of looking at the data and we can then make the assessment from there. We are seeing the little guys seeing value. And interestingly, note how these peaks are getting higher. They're seeing increasing value as prices come down even further. So this is kind of showing that that same dollar, those dollar cost average, for example, is going further and accumulating more coin. And their conviction doesn't seem to be wavered. It's actually quite impressive that they continue to stack. Now, again, this doesn't necessarily mean that they're right, but this is just what appears to be happening. If we then look to the whale addresses, we can see that they are also in accumulation mode, albeit softening over the last couple of days, but they are also adding something. I mean, you can see here, this is on the order of 140,000 BTC per month. So it's much, much larger than the shrimp here at 20,000 or 21,000. It's kind of a significant multiples above that. But these are really the two cohorts that we are seeing are accumulating. Now, the bands in between these, the 1, the 10s, the 100s, those kind of entities in terms of balance size, they've actually transitioned into net distribution. So really, any of the accumulation going on by these shrimps and these whales is essentially trying to compete with the distribution by these other balance cohorts. So that is the general profile of who is actually doing the accumulation at the moment. And again, we're just trying to look at all the information to assess what's really going on under the surface. So now we're going to transition and look particularly at the HODLer class. We've spoken over many videos over the last couple of months that really it's the HODLers who remain. They're kind of the last line of defense. And as we've seen with price action, so far they've been yet unable to establish a true price floor. So they are providing that support, but unfortunately it has not been enough to meet the amount of sell side that's going on. So if we look at the liveliness metric and the liveliness 90-day net position change. So what we're looking at here in the blue curve, liveliness is one of these very big picture metrics. It will trend higher when overall the market is destroying coin days, destroying time within the system. So the way to think about this, if someone's held their coin for 1 year and they spend it, they're a long-term holder, they're spending a lot more time, that accumulated lifespan. Conversely, if you've got someone who bought their coin yesterday and then spends it, they've accumulated very little lifespan, so they will affect this metric much less. And thus, we're trying to capture the old hands. What are the smart money doing? The people who've been here for a long time. So uptrends signify that we're getting spending by these older cohorts. You can see this all through the bull, and that shows up as this big 90-day net position change. We get this big surge of old hands selling their coins. Now, as we came into the May, June, July period last year, this started to transition back into an accumulation phase. We're getting more coin day creation, more hodling, more dormancy in the system. More coins are staying put in cold storage than are being spent. So we can see that this downtrend has essentially been in effect ever since then, albeit note with lessening degree. So this is a signal of accumulation, but note how it is getting softer over time. It's really a reflection of that macro uncertainty, and also with further price declines, more and more people lose interest, they walk away from the space, they capitulate out, and this is really the hodler class more or less diminishing down to its fundamentals foundation of who is going to stick around, rain, hail, or shine. So they are still in that accumulation mode, but it is softening. Now we can bring this into the supply domain with the HODLer net position change. This is now looking at it rather than in terms of liveliness or coin day destruction or creation. We're now looking at it in terms of BTC volume. And you can see here's that major distribution by HODLers during the bull. This is showing we're getting down to around 150,000 BTC per month being liquidated. What we can see over here is that we're sitting somewhere around 42,000, in the current realm about 20,000. So hodlers kind of represent a similar magnitude to the shrimp. And you can argue that these groups will probably overlap to a great extent. So again, we still do see net hodling going on. However, we can also see that it is declining in total volume. So there's a bit of a shaking in the confidence of the hodlers. And again, this is starting to look more like later stage bear market, when even the most strong-handed buyer finally is just capitulating out of the system. It's kind of this purge of all remaining sellers, and really a bear market floor can only happen when there just simply is no one left to sell. So this even has to affect the hodler class themselves. Now, we mentioned at the start that there's been somewhat of a deterioration of fundamentals. Now, this is the RVT ratio, the realized value or the realized cap to transfer volume. So what we're looking at is how valuable is the network based on the price when every coin last moves, kind of the on-chain market cap, for want of a better term. How is that compared to the amount of transaction volume or the utilization of the network? Now, very high values of this you can also see tend to happen. Here's 2015 at the bottom of the bear. Here's 2018 at the bottom of the bear, March 2020. Here's May last year or July last year. And here we are in our current regime. Now, very high values means that there is very little transaction activity relative to the market cap. In other words, it generally signals extreme bearishness. The fundamentals are not good. We're not seeing a huge amount of transaction volume relative to the market size. So in other words, the market is too expensive. It's too overvalued relative to the utility. Now, the other thing to remember that this can kind of work both ways. We see this come up to a similar point before it starts to reverse, because at that point in time, prices have fallen so much that we start to see people become interested again. This is the smart money coming back into the fray, and we see that RVT will start to decline. So you can see that it holds these low values during bulls. This is basically saying that the amount of transaction activity is justifying the current appreciation. The market is rallying alongside increasing volume, so fundamentals are stable. So what we really want to see in our current structure, we don't want to see this continue to break higher, because that would signal that the market continues to be overvalued and we're starting to get into somewhat uncharted territory if we break too far up from here. If, on the other hand, this manages to turn around and break lower, we start looking at a situation where maybe we're seeing that growing on-chain activity, even though prices are still depressed. So that's starting to signal improving fundamentals. We haven't seen it yet. In fact, it's looking a little bit grim at this point in time, but this is certainly a metric to be paying attention to. Do we get a strong break lower on the RVT? That would be a more constructive signal. And we can see a very, very similar thing with the entity-adjusted dormancy flow. So where RVT looks at transaction volume on a BTC basis, dormancy flow looks at it bringing in time. So we don't care so much about the volume of coin, we care about the volume of coin day destruction, the volume of lifespan. Are we seeing old hand spending, which is when you get these downtrends, these major downtrends in this metric? Or do you start seeing them actually picking back up and actually seeing more dormancy entering back into the system? So you can see that the same, when we get these very, very low values of dormancy flow, it's typically correlating with the deepest and darkest parts of the bear, March 2020, November 2018, and here we are languishing down at these lows. So again, what we actually want to see is this metric start to reverse, start signaling improving fundamentals. And much the same as the RVT ratio, if this breaks even lower, that would then also be a deterioration of fundamentals. It would be a negative sign. It means that old hands are continuing to exit their positions. On the other hand, if this metric breaks higher, it's showing that those fundamentals are actually improving, and we have older money or smarter money essentially locking those coins away, sticking them into cold storage, and further pushing towards some kind of a bounce from here. So these are two metrics to pay attention to in terms of improving or deteriorating fundamentals from here. Now, the last thing we're going to focus on is going to be the long and the short-term holders. Now, we've mentioned above, we've really focused on whether the longer-term holders or the smarter money are essentially reaching that maximum pain threshold, and we're seeing a purging of even the most bullish investors. Now, this metric is mapping out what we call the spent price. So think about this. If we cluster out our supply into long and short-term holders, they all have a different aggregate cost basis. Where they accumulated their coins, typically speaking, long-term holders have a lower cost basis because they include previous cycle buyers and longer-term investors, people from the previous bear. And short-term holders tend to capture more closely to the price. It tends to oscillate around the current price because they're the liquid coins that are constantly being traded. Now, when we talk about the spent price, we're looking at, of those coins that are being spent from long and short-term cohorts, what was the average cost basis of those spent coins? Now, remember, if long-term holders who bought during our current cycle, some of them are going to have a cost basis of $50,000. And if on average they are the ones who are spending, then the spent price will be higher. It signifies where are those coins coming from in terms of the price location. Now, what we're seeing here, when we're in this pink zone, this means that short-term holders are spending coins from a higher cost basis than long-term holders. It's typical of bull markets because short-term holders follow the price, whereas long-term holders still have a cost basis down here in the previous bear. During bear markets, that long-term holder cost basis is starting to come up the bull, and then eventually it enters the bear market, and when we get this purple zone, this is actually showing that long-term holders are spending coins from a higher cost basis than short-term holders. Long-term holders are now realizing losses. This is starting to signify a period of maximum pain. And yet again, see 2015, we're down at the bottom of this bear. This lasted about 500 days that we're in this period where long-term holders realized higher losses than short-term holders. Same again, 2018, in the late stage, right into the capitulation, we saw that long-term holders were in far more pain than the short-term holder class. March 2020, we had a very brief visit to this zone, and here we are entering this period where long-term holders are currently spending coins with a higher cost basis than their short-term holder counterparts. This is again signaling that long-term holders are now in that peak pain threshold. We're now starting to see all remaining sellers are being truly tested, and we are kind of entering that late stage of that bear where we see a number of these metrics all the way up signaling the same confluence. And the last metric that we're going to look at is long-term holders compared to the aggregate market. So in blue is the long-term holder realized price, the average price that they always paid, and orange is the entire market. And you can see that during bull markets, the long-term is much, much lower than the aggregate cost basis. So this is signified by this large peak. This means that the market has a higher cost basis than long-term holders, and long-term holders are essentially outperforming the market. They're in a huge amount of profit. Now, the flip side is that during bear markets, let's actually just zoom into the last 5 years to really make this point out. During the bear market, the blue curve, long-term holder cost basis, rises above the orange curve, which is the total market. This is now saying that long-term holders are now underperforming the aggregate market. They're in a more of a loss than everybody else. And you can see that this here also typically only happens at the late stage of the bear. We had it in 2018. We had it in 2020. Let's pull it back to our entire market to see this again. You can see we had it in 2011 and 2012, and we had it in 2015. So this is yet another metric that is now entering that deepest, darkest, final phase of the bear. And here we are just 5% above. We are approaching a convergence between these two metrics, which again signifies that even long-term holders, the smart money, the people who have a long-term time horizon, are now getting to the point of underperforming the aggregate market. So thanks for tuning in for that session, folks. It can be very challenging as we enter this phase of the bear. You'll note that there's a lot of volatility. The market continues to trend lower, and sometimes it can really feel like there's just no end to it. But what I really hope that we can see from all of this is that, again, we don't know when this bear is going to end, and we also don't know where the price will end up being. But what we're looking at is across all of these metrics, we're approaching that maximum pain threshold. We're getting to that point where we start to see the final phases of the bear, where all of that final profit is flushed out. Anybody who is going to sell eventually sells, and we're getting into that capitulatory phase where there is just simply nobody left. It can take time to happen. It is a painful process, but these things do eventually come to the end as the market tries to hammer out some kind of bottom. So stay safe out there, try and stay sane, and I will see you in the next one. Hang on there. Cheers.